This is the presentation for World 17 Team 1. Our group members are Marie, Sandra, myself, Eric, Tiffany, Vivian, and Layin. Our company history begins in 2005 when our CEO, Marie, created Pineapple Incorporated with the vision of creating unique, fashionable timepieces for the luxury audience. Over time, our vision changed to create affordable but still high-quality timepieces for the general population. Our C-suite consists of our Chief Executive Officer, Marie Darcy, our Chief Financial Officer, Sandra Garduno, our Chief Operating Officer, myself, Eric King, our Chief Marketing Officer, Layin Yoon, our Vice President of Marketing, Vivian Wong, and our Vice President of Finance, Tiffany Long. Our current position in the industry is not what we expected. We are underperforming in the industry due to a lack of sales and our expenses being higher than anticipated. The industry we're in is very volatile and very competitive. As far as industry sales, we began year 5, quarter 1 with a promising position around 5.2 million. Unfortunately, our sales dropped off by the end of year 6 down to 3.5 million. As far as net income, we started off year 5, quarter 1 with a positive net income of 124,000. Unfortunately, we ended up declining to negative 674,000 by the end of year 6. In regards to return on asset, we started off year 5, quarter 1 at 0.7, but unfortunately we were not able to effectively use our assets to generate a profit, and we ended at negative 4.8 at the end of year 6. Return on equity, we began year 5 with a positive return at 1.1. Unfortunately, due to inability to pay our loans and short on our cash flow, we ended at negative 17.3 at the end of year 6. Stock price, we began year 5 at a higher than the industry average of $1.41 per share. Fortunately, we declined by the end of year 6 down to 11 cents per share. Share, we began year 5 right about in the middle in the industry average at 20.4. We declined slightly down to 13.9 by the end of year 6. For our objectives, our financial analysis for the objectives is the return on assets. We had targeted 3.0. We ended at an actual of negative 4.8. This was due to our increasing assets but less profitability. For return on equity, we had targeted 4.6. Ended at an actual of negative 17.3. Our stock price, we had a target of $1.45. Actual was 11 cents, and this was due to shares issued to public in order to raise our cash flow. For the market share analysis, we predicted it would remain constant. We targeted a change of about 3%. We ended up at the end of year 6 having an actual change of negative 7.3%.
Initially, we aimed to lower our unit production costs by expanding foreignly into Sereno. Due to our financial position, we were unable to expand to Sereno. Our targeted unit production cost was to be $6.41 per unit. Our actual was $6.95. The difference in the cost that we aimed between our actual was the fact that our planned expansion was unrealized, and we had to continue expansion in our headquarters in M1. We anticipated a 0.08 increase to our total net income for year 5 and 6. We did not have a 0.08 increase, we actually had a decrease, and our total net income was a deficit of $674,000. This was largely due to our higher than anticipated operating expenses, and also due to the large bond and loan interest we were paying in year 5 and 6. So our former strategy was to concentrate our business in the areas of operations, finance, and marketing. We aimed to maximize our full product potential and attract a significant and loyal customer base and build brand reputation. We plan to achieve this by initially offering a product at a lower price with a better quality to attain customers. So due to our financial position in year 5, we had to have a drastic change to our strategy. We had decreases to our non-essential and essential operations such as marketing, research and development, HR and staffing, and our foreign expansion in Sereno. Our strategy at year 5 then became a strategy of differentiation. We also looked to lower our costs to offset the debt by decreasing our non-essential and essential functions. So our key areas for strategy are marketing, HR and staffing, research and development, capacity, inventory, and finance. So As differentiation was central to our strategy, research and development played into a big part of our strategic direction. Our initial plan was to gradually increase R&D over years 5 and 6. As we decided to cut back on essential and non-essential functions, we actually decided not to gradually increase R&D. We did, however, introduce a new model in quarter 4 of year 6, which was consistent with our differentiation strategy. Our strategy in regards to capacity and inventory was to lower our overall costs. Due to our financial position, we had to suspend our plans to expand foreignly to Sereno, which was to cut our production costs. We continued production in M1, and we also made a change to our pricing to control inventory to help us not have a stockout issue.
Our actual price turns out to be lower than our forecast price. We plan to increase 20% in every quarter 4 because we plan to sell a new model in every quarter 4. But due to our financial situation, our actual price turned out to remain the same in both year 5 and 6. Product price in year 5 we changed it slightly but significantly in year 6. We plan to increase our product price in every quarter 4 because we plan to sell a new model in every quarter 4. In year 5 quarter 4, price was not adjusted successfully due to the faulty problem of the system, but in year 6 quarter 4, the actual price turned out to be higher than our forecast price by 8% higher in America 1, 3% higher in America 2, 5.7% higher in America 3, and then 3% higher in Sereno. For market research, we purchased our market research in year 5 quarter 1, which is the consumer preference study. We wanted to get the most updated information of what the consumer decide from the product. In the following quarter, we adjust our quality of the product and features of the product accordingly to our expense of the different level of the quality and features, and accordingly to our consumers' preference. Training, we plan to increase 3% in every quarter 2 and 3 because we plan that the new model will be ready in quarter 2 and then start to manufacture in quarter 3. But for our actual price, due to the financial situation we faced, we decided to keep the training expense the same in both year 5 and 6. Salespeople, we wanted to maintain at least 12 salespeople in all America areas and at least 14 salespeople in Sereno. In year 6, total of 16 salespeople had resigned, but we took into consideration of expenses for training, salary, commission, and other related expense. We only hired 2 salespeople in year 6 quarter 3. Salary and commission, we plan to pay our salespeople by base salary plus commission, and we plan to increase 15% in all America areas and 8% in Sereno. Due to our financial situation, we didn't meet our goal to increase our commission. In year 5 quarter 4, our actual commission was deviated by 17% in all America areas and 7% in Sereno. And year 6 quarter 4, our actual commission was deviated by 33% in all America areas and 14% in Sereno.
So for year 5, our financial strategy is to repurchase 1 million of bonds in quarter 1 because we have excessive amount of cash on hand. But when the results came back in quarter 1, it turns out that our cash was lower than we expected. Therefore, in quarter 2, we reissued back that 1 million bond out. At the same time, in quarter 2, we also repurchased 500,000 of shares because in that quarter, we came in 3rd in the stock price. Therefore, we were hoping that we could win, at least in one of the weighting factors. We repurchased 500,000 shares for 3 consecutive quarters because we want to win that factor. But for this reason, in quarter 3, we were issued our first emergency loan with 3.4 million. For quarter 4, we were issued for another emergency loan for almost close to $3 million. But at the same time, we weren't expecting to repurchase our shares back for quarter 4, but because there's a glitch in the system, our quarter 3 decision was reused in quarter four. Therefore, that's why we repurchased 500,000 shares when we were not supposed to. We also didn't issue any stocks to the public because we were repurchasing it during the whole year. So for our year 5 financial performance, we actually had a net sales of 21 million in total, where most of our sales comes from area 2. But at the end, in our annual statements, our net income was a negative 24,000. That's because even though we have a really good net sales, our expense was really high at the same time. And most of our expenses were coming from our loan interest and bonds interest. They were close to 500,000 for the whole year. So in year 5, our total emergency loan was close to 5.5 million, but by quarter 4, we were able to repay almost half of our bank loans, which was close to 2.4 million. By quarter 4, we had an ending cash balance of around 1 million, and it was kind of considered low to bring it to year 6. By quarter 4, we have 5.4 bonds outstanding.
Okay, so for our net income for year 6, quarter 4, we ended up with the negative 6,774, and this is because our expenses were too high compared to our revenue. We had all these unit prices which were lower than the market share price. We had the advertising expense and the unit production expense as well. For year 6, quarter 4, we ended up with cash on hand of $482,000, which was considered really, really low compared to the other companies. For loans, for year 6, we ended up taking emergency loans for each quarter. As you can see, they're listed on the PowerPoint slide. And we also ended up the gain with the emergency loan, in which we weren't able to pay on time for that last emergency loan. Okay, so for bonds, we issue $5,400,000 for year 6 for each quarter. And for stocks, there was 2 quarters that we issued 8,500,000 shares, which was quarter 2 and quarter 3. For stock price, at the end of the quarter of year 6, quarter 4, we ended at 0.11 for the stock market price, which was very low compared to the other companies. And for dividends, we didn't issue any dividends at all to shareholders because we didn't have any cash on hand, and we needed whatever cash on hand to pay for other expenses. And for CDs, we took CDs out by year 2 because the interest was dropping down by each quarter.
At the end of year 6, our company is facing a very serious financial issue. We need to pay back all our debt in year 7. So year 7 is very crucial to our company. In order to do that, we will increase our market share by sales, and also we will bring our stock price up. We also will minimize our expense on advertising, commission, salary, R&D, and training as well until the end of year 7. For our financial strategy, for loans, hopefully we will not issue any more loans, but if we really need cash, we may borrow another loan. If we do, we will calculate our expense correctly. For the CD, if we have enough cash at the end of year 7, we might invest to a short-term CD to earn interest. For the stock price, we expect our stock price to increase by 2% in year 7, as well as our market share. Hopefully, our market share will increase 2.5% by ourselves. For the bonds, if we have a good financial condition, we will buy back our bond to avoid high interest expense. For our operating strategy, we decided not to expand in all areas. So the reason is we have enough production line to handle our sales order, and also due to the financial issue, we decided not to expand anymore. No new lines or new plans in all areas. For salespeople, we will maintain 10 salespeople in all areas. we might hire more, depends on our sales order. For inventory control, we will improve our strategy, and hopefully we can have a better control on our inventory, so we won't have a lot of ending inventory left over. Our marketing strategy, we will continue selling Model 5 in year 7. We might not present Model 6 until the end of year 7 or the beginning of year 8. We will set the price to the lower price, so we hopefully use lower price to get more customer and high volume sales. For advertising, we will increase by 5% at the end of year 7. So this will be conclude our plan for year 7. Thank you.